or the values of their bank accounts, as well as the values of their financial securities accounts, which includes, obviously brokerage accounts and all sorts of things. And this is actually much more likely to lead to disclosures for tax purposes for U.S. people, because the IRS can actually easily match the asset base of the person to the actual tax being filed. But the more interesting thing is that they can, from this form, identify accounts which may have come from or may be with a complying foreign financial institution. And obviously the withholding will apply from 2014, and it may take some years for the system to filter through, but the IRS will be able to determine which foreign financial institutions are being compliant or not. And I'm sure that where it's an innocent mistake, it's hard to see how it can be innocent for a major institution. I'm sure there wouldn't be penalties, but I can see penalties being levied on institutions that don't comply with FATCA. And now, people in the audience may all be saying, well, gosh, actually I'm not a U.S. taxpayer, I'm not worried at an individual level, or indeed you may be representing an institution which is worried at an institutional level. But the point about FATCA is it's very pervasive, and since the UK government have seen this attempt to get information about account holders, and I think you'll find that Philip and Richard will come on to how will financial institutions reveal information about their account holders. Will it be directly to their own government? Will it be directly to the IRS? It's been perceived that this is a very good idea, and other countries have actually decided to follow suit, and we see knock-on effects from FATCA already, in that the UK are actually asking for automatic reporting of bank and securities accounts information, for example, between the G5 following a FATCA process. But it's very much more likely to spread. So it's not just necessarily account holders who are U.S. persons who actually have to worry about things like FATCA. It is actually, I think, becoming more prevalent, and you'll see that on this slide, this is certainly knocked on. Also for the Channel Islands as well, for UK persons having accounts in any of Bermuda, Cayman, Isle of Man, indeed other UK territories, they will also have to be aware that this is actually also extended to them, and I'm sure within the EU as well. So we do need to have a better understanding of FATCA. Now, I don't want to hoggle the talking here, but I would just like to have my final slide. I think obviously most securities houses will have got to grips with, and foreign financial institutions will have got to grips with what they have to report. And in Hong Kong, for example, and in Singapore, we're going to have a sort of Type 2 governmental agreement with the US on this matter. So it's really just sort of reporting to the IRS directly. It's not necessarily reporting to the Hong Kong government or the Singapore government, because they just haven't got the capacity to deal with this type of reporting. And indeed, it's not a reciprocal reporting. So the good news is, well, in fact, Hong Kong really doesn't care less about reciprocal reporting. They don't wish to know about Hong Kong residents in the States, for example, who've got bank accounts there, which would be reciprocal reporting. But I'm sure people who've got sort of a Type 1 intergovernmental agreement for FATCA, for example, say the UK, would be very interested to know which UK persons have got bank accounts, say in the United States. At that level, institutional level, I think it's moving along, although slowly, very, very slowly. I think in the industries where we are here in Hong Kong, the issues are for trustees and private trust companies where there are US beneficiaries or indeed US investments. Now, the good news is that in the January regulations that came out, in fact, there was a major concession in that if one of the trustees of the foreign trust is actually an individual, going to be a name and blame person, then that trustee, that foreign trustee, doesn't have to be FATCA compliant. And I think, obviously, major family trusts and private trusts, therefore, are still not going to have to be FATCA compliant, so that when payments are made to US beneficiaries, for example, there's no withholding. But where there is a corporate trustee, which is not an ordinary financial institution as we would understand it, let's just say it's a private corporate trustee, then it will have to register for FATCA as if it were a financial institution, and it has to obtain a global information number or withhold tax, so that when payments are made to the beneficiary concerned, if the payment is made gross, that has the GIIN has to be actually reported with that payment, so at a practical level. So that's the global information intermediary number. That would have to be quoted if the monies are actually paid gross. Otherwise, the backup withholding tax rate is 30%. And unfortunately, the theoretical deadline for those applications by foreign financial institutions, i.e., for example, private trust companies, in theory was the 3rd of May, which was last week. So I'm sure they'll extend that deadline. But this has a much wider effect than people might believe, because it's not just, for example, private trust companies that have to consider this. It'll be things like, foreign financial intermediaries such as, Cayman mutual funds, and all of those sorts of types of vehicles where payments are being made out to U.S. persons. They will have to get the GIN number, and this is even despite all of their beneficiaries, for example, having signed whichever relevant form it might be, a W8 or a W8-BEN, W9, W8 IMY intermediary forms. So this is the practical impact, I think, on a lot of people who are operating here in Asia. And really, it's a question of whether the private trust company is going to go and get the GIN, or whether it's going to put on an individual, if it could, as one of the trustees, or indeed for all those Cayman funds and other private equity funds, whether they have to also go and get the GIN. And I really believe that they do, otherwise they're going to have to operate backup withholding, and eventually, if none of that happens, it will flush through on Form 8938 in the U.S. taxpayers' tax return when they declare that they have received that type of distribution from, or they have got that type of holding in a foreign financial security. So this is certainly how I see FATCA at the moment, sort of at a practical level. And I think I'll stop there and perhaps hand over to Philip.
Thanks, Debbie. This is Philip Rod from Ernst & Young. What I'd like to do next is talk through a few of the practical aspects of FATCA and how it will impact financial institutions in the region. Basically, you can think about 4 things that financial institutions need to do to become FATCA compliant. Maria, could you move the slides on, please?
I'll try moving it on.
So the first thing that financial institutions need is to review their onboarding procedures. So they need to review the onboarding procedures for new clients so that they can identify any US persons. The second thing financial institutions need to do is review their existing clients and identify if there are any US persons amongst their existing client base. The third thing is reporting. So for those US persons that are identified, there are certain reporting requirements. And the fourth thing is withholding. So withholding applies when you have a client which you suspect may be a US person or is a non-participating FFI. You then have to apply withholding against their US sourced income. So for those 4 things, the first deadline is actually developing new onboarding procedures for new clients, and that needs to be done by January 1st of next year. I've listed up on the screen here 10 practical issues in terms of actually implementing the new requirements. I'd like to highlight a few of these today. The first item I've listed is IGA, so intergovernmental agreements. Quite often when I talk to clients, there's a view that, if we sign an intergovernmental agreement, we don't need to do anything. As you may know, Hong Kong is in discussions with the service in the US about signing an intergovernmental agreement for Hong Kong, as are a number of other countries in the region. Although it does simplify the process somewhat in terms of the reporting and withholding, it doesn't completely remove the burden on financial institutions. So financial institutions still need to go through and update their onboarding procedures and review their existing clients. The other challenge we have with IGAs is, although 5 IGAs have been signed to date, there are 50 countries under discussions with the Inland Revenue Service and the Treasury in the US about signing IGAs. And we don't really know how many of those are going to be signed before the year end. So for those of you that are implementing FATCA programs within your financial institutions, you have to take a view. Most of the clients we're working with are taking a very prudent view and saying that if an IGA isn't signed yet, we will assume that it's not going to be signed before the year end, and we will change our procedures accordingly. The second item I've listed is EAG, so the Extended Affiliate Group, and joint ventures. One of the challenges with FATCA is for your Extended Affiliate Group, which includes all entities which you have more than 50% shareholding in within your financial institutions. It's an all or nothing thing. So all of the institutions, all of your subsidiaries, branches need to be FATCA compliant, and if they're not, that taints the whole group. So it's a challenge to make sure that within a FATCA program you can maintain compliance throughout the whole group. JVs which are less than 50% don't need to be compliant because they won't taint your group, but then there are potentially reputational issues if you have a JV which maybe has your name as a financial institution on, but does not become compliant, and it does present certain operational challenges to financial institutions in that case, because you would have a JV which could be a non-participating financial institution and a group which is participating, and any transfers between those would be potentially withholdable. The third item I've listed is onboarding for entities. As I mentioned earlier, one of the first requirements is to review your onboarding procedures for new clients. And that can be relatively simple for individuals, but for entities there are a number of different classifications for entities, in fact up to 26 classifications in the FATCA regulations. So that can be quite challenging to implement to meet the compliance requirements, but also come up with a process that is practical and realistic for your front office teams to actually use. The fourth point I mentioned, which Debbie also discussed, is US persons. So quite often the initial reaction to FATCA when it came out from some institutions was, we're not going to deal with US persons anymore. So one of the considerations for financial institutions is to actually go through on a country-by-country, business-by-business basis and assess, do we still want to deal with US persons? Is it even legally possible not to deal with US persons? And that needs to be built into the program. The fifth point I mentioned is recalcitrants and non-compliant counterparties. So the recalcitrants are those clients that you have where you have a question about whether they're actually a US person or not, but they do not provide sufficient information for you to make that decision. You then need to withhold on those accounts. And there's an expectation from the Treasury and the service that for financial institutions, the number of recalcitrants that they have will actually reduce over time. So that's a challenge in some cases. Maybe there's not a legal mechanism for certain business types for you to close accounts for recalcitrants, or if it's an insurance business, you can't unilaterally cancel an insurance contract. So how do you actually achieve that in practice? One of the things to remember here is, although there are withholding requirements under the FATCA regulations, the main goal of the IRS is actually for the reporting rather than withholding. Because the IRS, when you report, the IRS gets data more broadly on individuals who are US persons and potentially taxpayers than if you're just withholding. The sixth challenge I've mentioned is sponsored entities and deemed compliant FFIs. This particularly applies in something like the asset management industry, where fund managers can potentially be sponsoring entities for their individual funds. So that's something that asset management businesses need to take into consideration. The seventh item is de minimis and aggregation. There are certain de minimis limits below which you do not need to report. And those are different depending on the business type. But the financial institutions that we're dealing with are going through a consideration process as to whether actually to utilize those de minimis limits or not. In some ways, they can greatly reduce your potential reporting requirements and the volume of work, but in other ways they can present certain challenges in terms of how do you actually calculate de minimis limits and how do you potentially aggregate different accounts for the same person. Changes in circumstances. Those of you who've been working with FATCA are probably familiar with this term. It sounds a bit strange. But what we're talking about here is for your existing clients, when you onboard the clients, you get the relevant KYC information from the client. But what if subsequently there's a change of address for the client, or if it's an entity, say it's a corporation, there's a change of shareholding for that particular entity. That's a changing circumstance. And what if that new address you get is a US address? That then presents the question as to, is that person now a US taxpayer? Have they moved to the US and got a green card or something? So you need to build into your processes how you can actually deal with that. Responsible officer is number 9. That's a term within the final regulation. And the responsible officer is someone that needs to certify compliance to the revenue. Those actual certification procedures do not apply for a little while, but we do recommend that institutions actually decide who will be the responsible officer going forward, because although the certification does not take place for some time, the actual requirements in terms of, for example, one of the requirements is making sure that you're not assisting any of your clients in evading the FATCA regulations, are actually existent right now. And the 10th item I mentioned is data search challenges. So for your existing clients, one of the requirements is that you actually go through and search your data records to identify what's termed as US indicia, so any indications that that might be a US person, such as a US address or a standing order to pay to a US account. And although that might sound simple in practice, actually achieving that in practice can be quite challenging. So those are some of the practical issues we see when we're working with clients in actually implementing FATCA. Maria, can we move on to the next slide, please? Thank you. On the next slide, I've listed some of the focal points for the next 7 months. As we know, the first deadline for compliance is actually January 1 next year. The actual registry will open before that. So the register will open in July this year. So financial institutions, they will be able to complete the registration process for their group. And there will be a list published in December of all of those registered FFIs. And you need to register before October, date in October 27th, to actually get on that first list. But in terms of what programs should be focused on over the next 7 months, I've listed a few items. I'm not going to go through them all in detail, but a lot of institutions started their implementation process last year or maybe even the year before. And since the final regulations were issued, there were some changes to the requirements. So I would recommend that institutions actually go through and update their implementation plans based on the final regulations, and also the IGAs as they get signed. There's been a few notices recently about countries that are intending to sign IGAs. Third point is particularly important. When you register, each institution, each entity within the group could register separately, or you can register as an overall group. You need to identify which entities within your group will actually be FFIs. So you need to go through a legal entity analysis. The fourth item I mentioned is going through and building your new onboarding procedure. And that may well involve some kind of system changes because there may be additional data fields that need to be captured to actually implement that in practice. So you need to allow time to actually make those changes and go through the testing procedures before implementation. The next item I'd like to just mention is item 8, so communications. A lot of financial institutions are probably already receiving questions from their clients. What is FATCA? What does it mean? What does it mean for my account? So financial institutions need to start thinking about what their communication program should be externally for their clients, but also internally for people in operations that need to handle the processes, front office people that need to deal with clients on a day-to-day basis. The ninth point I'd like to mention is updating legal requirements. One of the things that when we work with clients we do is we review who are your business partners and what is your relationship with those business partners and how are they represented in the legal contracts. And we're seeing now, for example, is the documentation now can include the FATCA term. What we're seeing now is clients going through and reviewing those legal documents to specify the roles and responsibilities for different partners under FATCA and how that will actually operate in practice. Lastly, I'd just like to mention, although the first date for implementation is January 1 next year, that's really only the start for FATCA. There are a number of implementation dates after that. So what I would recommend is clients actually go through and start to plan for those subsequent implementation dates and make sure that there's budget and resources in place for those. So from a practical perspective, those are the issues that are facing financial institutions in the region as they implement FATCA. Thank you very much. I'd like to hand over to the next presenter now.
Okay, this is Richard Wiesman from Baker McKenzie. Can I just confirm that you can hear me fine?
Yes, we can hear you.
Okay, that's great. Okay, let me begin by providing an overview again of where we are in the overall process and sequence of implementation of the FATCA requirements. And if I could have the first slide pulled up, please. So, as the previous speaker mentioned, FATCA was actually passed into U.S. law in 2010. The first extensive guidance was issued in February 2012. Those were the proposed regulations. And we and others provided comments on behalf of the Hong Kong financial services industry and others to try to modify those proposed regulations to make them a little more workable for financial institutions internationally. I actually met with the Treasury Department in June of last year to discuss those comments, and there were some favorable changes made in the final regulations, which were issued in January of 2013. And I would say that really once the final regs were issued in January 2013, we saw much greater intensity of focus on compliance with FATCA among financial institutions here in Hong Kong and elsewhere. People finally came to the realization that indeed FATCA was not going away, it is going forward, and it really is essential that now people do everything they can to attempt to comply with FATCA, by the time the various obligations come into effect. In terms of ongoing activity, the U.S. Treasury Department is continuing to negotiate the so-called intergovernmental agreements which will have a major impact on how FATCA is implemented in various jurisdictions internationally. So I'd say that in terms of the FATCA withholding rules, there is a phase-in of those rules. And the phase-in is very important, both in terms of the institutions with withholding obligations and also for recipients. So beginning January 1, 2014, there will be withholding on U.S. source income payments, so-called FADAP income, where those payments are not grandfathered. In other words, where the obligations involved are not grandfathered. But that withholding will apply on the income portion only, not on the principal portion of those payments. January 1, 2017, withholding on gross proceeds on obligations that are not grandfathered will come into effect. So that will be a very material change, because the consequence, the downside of the withholding will be dramatic. Withholding will apply on gross proceeds as opposed to just the income element. And furthermore, January 1, 2017, withholding obligations are scheduled to apply with respect to the so-called foreign pass-through payments that are not grandfathered. And those are payments from the foreign financial institutions to other FFIs, from participating FFIs to other foreign financial institutions that are not participating. So that will be another dramatic phase in terms of the FATCA scheme of compliance. And FFIs that are not compliant by that date will face the prospect of having payments to them withheld upon, even if those payments are coming from non-U.S. financial institutions. I would say the effective date of the obligations with respect to pass-through payments is still significantly uncertain, because the final regs have to be issued to provide guidance with respect to pass-through payments at least 6 months before their effective date, and those have not yet been issued even in proposed form. Okay, so then if we move on to the slide that says key dates on it, key dates include July 15, when the IRS FATCA portal will open, so financial institutions can begin their registrations. In October 2013, the so-called GINs, these global identification numbers, will be assigned. And October 25 will be the last date for PFFI registration, in order for financial institutions to be assured that they will be on that first list of PFFIs that are issued later in the year. At the end of this calendar year will be the cutoff date for grandfathered obligations. In other words, debt instruments that are issued prior to the end of 2013 can benefit from a grandfathering status, providing there are no material modifications after that date. But December 31 will be the cutoff date for that status. Then January 1, 2014 will be the effective date for the FFI agreement. And as previous speakers noted, the new account opening procedures will be operational, etc., by that date. So if we can move on to the next slide, international tax policy considerations. The underlying policy which drove FATCA was combating tax evasion, in particular with respect to U.S. persons. Of course, the FATCA scheme is really incredibly far-reaching. And so while the goal seems to be focused, the approach that's being taken in order to achieve the objective is incredibly broad and is imposing really widespread and onerous international tax compliance obligations on financial intermediaries. It is not going to get easier. it's only going to get tougher because, as Debbie alluded to earlier, European jurisdictions are likely to move in similar directions. So in terms of the future, I think that people who were hoping that this would go away are going to be very disappointed. This really is the beginning of a new age of international tax compliance obligations on foreign financial institutions. The impact of FATCA on private banks and wealth management industries in Asia is enormous. Huge new compliance obligations and related risks, incredible cost and complexity, and it really is critical that FIs manage the risks related to FATCA because the risks are very, very substantial. In terms of compliance issues, FATCA now gets layered on top of KYC and AML obligations. Our experience is that there is very wide variation in the work done thus far by FFIs in Asia. Some are quite prepared. Others don't even yet appreciate the extent of their obligations. The cost of compliance undoubtedly is very high. The ramifications of non-compliance will be even higher. And then in terms of still to come, there are many items still to come in terms of the release of the FFI agreements and other items noted on that next slide, and of course the IGAs being negotiated around the region and internationally. So AJ, I think I will pause there to give you time to go through Q&A and ask questions and to have some interactive discussion.
Okay, thanks, Richard. Just one macro level question that I think picks up nicely where you left off about combating tax evasion. At a macro level, what are your overall impressions about the final rules that came out in January and then they were revised? I mean, does it strike the right balance between thwarting tax evasion and giving people enough room to plan their affairs?
Well, the final reg is much better than the proposed reg. Okay, so they were carved back and made more practical in a lot of respects. I think the general reaction of most FIs will be that the obligations are staggeringly complex. But really, I think that the underlying reason for that is that the IRS's experience dealing with other more modest compliance regimes, like the QI regime, is that there are ways to plan around more simple approaches. And so the whole design of FATCA is extremely complex and comprehensive because it's attempting to anticipate lots of potential approaches that people could use to evade. So I would say that, big picture, this new compliance approach is really complex, comprehensive, and onerous, but we understand where it came from because more simple approaches have been evaded. Okay.
Flowing from that, would you say bank secrecy is dead in the modern age, or might there still be some remnants of driftwood to cling to? I mean, this is for the entire panel.
May I comment on that then? I think that's sure. The whole objective of FATCA, AJ. It's not just a question of reporting bank accounts now. Every institution is to report any type of security or account that they have. Eventually, the idea is that they will be reporting of whichever nationality, not just U.S. This is not really... I mean, obviously it started off with a U.S. initiative, but I think that the OECD and the sort of like civilized world realize this is a way of tracking securities and bank accounts and assets held by taxpayers really in all OECD jurisdictions. And that's what Rich is actually saying. This is boiling down to transparency for all of them and ultimately trying to force them to actually declare all of their assets in their tax returns. I think this is the nub of the matter. And of course, because the financial world is so complex now with so many different types of accounts and asset holding structures and so on, that is why FATCA is so complicated. So banking sovereignty is dead. I mean, this is really what I think the objective is. Philip, would you agree?
Any thoughts?
Hi, Phil. I would definitely echo Debbie and Richard's comments. We're moving towards greater tax transparency. There's the announcement just 2 weeks ago from Luxembourg about the moves there to greater transparency. Clearly, we're seeing a couple of drivers for that. I think governments, particularly in the Western world, definitely need the tax dollars right now. So they're anxious to increase their overall tax base. But also there's a growing backlash, shall we say, against tax evasion, and there's less willing acceptance amongst the public in general, I think. So this is being seen in all Western countries. I think the only interesting point will be when it potentially moves to Asian countries actually starting to ask for more information as well, which is one of the potential items that comes up with the IGAs, particularly Type 1 IGAs, in terms of reciprocity of exchange of information.
All right. One of our attendees would like to know if there's a requirement that non-financial foreign entities should be classified, and if so, what's the reason for that, since the aim of the legislation is to only report on U.S. identified accounts. Any thoughts?
So non-foreign financial entities don't need to register.
Okay.
FIs do need to go through a classification process for each of their entity clients. They need to go through and classify their non-foreign financial entities. But the NFFAs don't actually have to register themselves.
Okay. Something that several people are curious about is it's unclear whether China will accede to America's wishes regarding FATCA. Can we expect Beijing to be a holdout to FATCA's global rollout? I mean, what happens if a player as large as China decides not to acquiesce and then sign an IGA, and then you have the situation of what happens to the many financial institutions within China that are still not compliant, anywhere near as being compliant. Richard?
Well, there's been no public announcement by the Chinese government or by the U.S. government regarding the intention of China. There have been reports in the media, but frankly, they're unverified reports, so I'm not really inclined to go into that right now. If China were not to, well, first of all, I think that most people do anticipate that China will enter into an IGA. No, but if China chooses not to enter into an IGA, then PRC financial institutions will still have a decision about whether they wish to become participating FFIs. And if they were not to be participating FFIs, then that would be very, very significant and problematic. So, it remains to be seen exactly how that's going to play out, but I think that most people do anticipate that China will sign an IGA.
And may I comment on that too, AJ? I mean, if the intention is really to get the whole world onto a tax transparency model, China is going to go along with that because they're not going to be the ones who are not helping with that proposal. And indeed, if China does sign an intergovernmental agreement, I'm sure they would be very interested to know about all the Chinese bank accounts being held or the securities accounts being held by Chinese nationals or Chinese residents in places like the States or indeed other places in Europe, for example. So I think China will actually go along with this because it's a bigger initiative than just flushing out U.S. delinquent taxpayers.
Okay. The next question from the audience goes to sanctions. There seems to be the notion that FATCAs criminalize tax evasion as a predicate crime. Does the statute, or the regs for that matter, do they provide any guidance on tax evasion typology?
Actually, the U.S. tax code and existing tax law pre-FATCA has lots of rules about what constitutes U.S. tax evasion. Actually, I think I see FATCA as really, it's a compliance regime. So, I think that tax evasion under U.S. law would be defined under the code and regs and existing court decisions as distinct from FATCA itself. And FATCA is really more of a compliance regime, and the penalty for noncompliance with FATCA is being subject to this enormous withholding tax.
Okay. Deb, I'd like to turn to you with trust companies and company secretarial and tax planning service providers in the public eye these days. What do you see as being the practical impact of FATCA on them?
I think it's not a practical problem for company secretarial practices, people just administering companies. But I think for trustees it is a problem. Private trustees, as I've mentioned before, have got to consider whether, because they're a corporate trustee, whether they have to register and obtain a GIIN. And in fact, the date for application had been put back. I think on my slide it does say 3rd of May. But in fact, I've done that last week and it had actually been extended back. And indeed, I believe it will be extended back again in terms of the application dates. But the point is, if there will be a payment and a GIN number has to be applied to it, I mean, the trustee is supposed to be reporting distributions and so on every year. And in terms of not withholding, they're going to have to put their GIN number on to justify the non-withholding, in my view. So I think trustee companies, for example, in Hong Kong or in Singapore, that are not part of a financial institution that is already going through the whole FATCA thing and program, is going to have to decide whether to make that application or how to deal with this. Or indeed, in particular cases, they may decide to have an individual join in as a trustee with a corporate trustee if it's possible in a particular circumstance and if there's a suitable individual. So that's how I would see it, certainly at a practical level. And that's based on what we know now. And we don't know whether that will be appropriate in 2, 3, 4, 5 years' time. We still don't know.
Okay. Another more pointed question. Will IGAs, especially with Australia, will they remove the obligation to register FFIs or allow for local registration rather than registration with the IRS? Any thoughts?
Are you talking? Is that a question pointed to me, or I think perhaps Philip or Richard may be better?
Entire panel. Yeah.
It depends on the model. It depends on the model. So basically, IGAs broadly fall into two categories. There's a so-called a Model 1 and a Model 2. And under the Model 2, the FIs will continue to register with the IRS like they would outside of FATCA. There are still some significant benefits to Model 2 status for FFIs in a jurisdiction. I mean, there are pros and cons, but the registration process would still be directly between the FFI and the IRS. In contrast, under Model 1, the local FFIs would be dealing with their own local tax authorities, and the information would be passing up in that direction. So we don't have enough specific guidance about, how countries, the specific rules that countries are going to adopt domestically but they'll have to be broadly in line with the FATCA rules. But certainly the registration process would be local. Now, having said that, the reality is that any reasonable size FFI has operations in multiple jurisdictions. So let's say that an FFI has some operations in a Model 1 country, some operations in a Model 2 country, and some operations in a jurisdiction that has no IGA. Then where there's the Model 1, there wouldn't necessarily be a registration with the IRS. That could be with the local authority. But then in the other jurisdictions, there will need to be a registration with the IRS.
Thanks for that, Richard. Practical query from Singapore is how do you suggest people handle situations where there's a conflict between FATCA requirements and local regulations? I guess that's a perennial concern.
Well, it's going to depend on the jurisdiction. So, I mean, one very positive thing about the IJA. So, if the question relates to Singapore specifically, Singapore is expected to sign an IGA with the United States. When a jurisdiction does sign an IGA with the U.S., then it's committing to change its rules, any local laws that would preclude FIs from complying with FATCA. So if you're in a jurisdiction of that nature, you can, expect that those rules are going to be changed. Now, one problem for a lot of FIs in Asia is that we have significant uncertainty about which jurisdictions are going to sign IGAs and when are they going to sign them. So, where there is the conflict, first you would do an analysis of whether it is possible to deal with the local law restrictions by modifying, for example, the terms that govern your relationship with customers. If that is not sufficient to enable you to get around the local law obligations, then obviously you have to satisfy the local law obligations, but then you'll have a bit of a transition period under FATCA rules before the more adverse ramifications of that status will kick into effect.
AJ, if I could just add on a couple of points.
Yeah, Philip, you go ahead.
Sure.
Yes.
Yeah. So the final regulations actually recognise that challenge and present a compliance status for, say you have an entity within a group which is in a country where the regulations actually preclude compliance with FATCA. You can apply certain requirements to that entity, and that will then not necessarily taint the rest of the group, which would be the big risk, I think, for most multinational financial institutions. And there's a kind of a 2-year process whereby I think the expectation from the Treasury is that within those 2 years, as more countries sign the IGAs, which will help to assist in getting around any of these conflict of law issues, that would then get resolved.
Okay. Yep.
And may I also just comment that Singapore had actually changed its rules regarding, for example, criminal offences and tax evasion, and keeping proceeds of tax evasion is now criminal, or the legislation has been changed to make it a criminal offence in Singapore, whereas that wasn't certainly a money laundering or criminal offence until fairly recently. So they are changing their rules in Singapore to be compliant with what I would describe as international standards. So therefore, I think that the Banking Secrecy Act, I think banking secrecy, securities account secrecy, all of those things, those are all things of the past. I think that people who are listening in just have to be realistic, again, these accounts and so on are going to have to be declared, not just by U.S. persons, but wherever the person is resident. That will catch up with them one day, in the not too distant future.
Okay. Curious question: are exchanges, stock exchanges like HKX, SGX, will they fall into the definition of a foreign financial institution under FATCA? If so, why? Richard?
Yeah, it's a complicated rule, and technically they may well, but frankly, I think that discussing their responsibilities then is a pretty probably beyond the scope of what we're going to get into right now. But financial exchanges definitely do need to check their status under FATCA.
Okay. A great deal has been said about financial isolation, being cut off from the U.S. markets, 30% withholding. One of our attendees would like to know what other key risks they might face if they don't register with the IRS under FATCA.
Hi, AJ, this is Phil. I guess there's a couple of things I'd highlight. One is reputational issues, which may come around if financial institutions aren't registered. Obviously, all of the FFIs will be published on a public website, so that will be readily available to everyone. And secondly, in dealing with other financial institutions and business partners, one of the considerations is, does a financial institution continue to deal with a non-participating FFI because of the operational challenges that will actually result in for the FFI. So not just financial isolation from dealing with US investments, but financial isolation from dealing with FFIs may be one of the potential consequences of non-compliance.
Okay, thanks. Another query goes to the interplay between existing KYC, AML protocols and procedures that banks already have. And someone wants to know to what extent will that help with FATCA compliance? To what extent does it need to be augmented? Any impressions?
It does need to be augmented. Go ahead.
No, Richard, go ahead.
No, I was going to say it does need to be augmented. I mean, it will, in some ways it'll help, in some ways it may complicate their lives. But, I mean, the key is that you have to follow the FATCA rules in terms of reviewing existing accounts and then new account opening. So, to a certain extent, those rules do reflect, kind of the more conventional KYC rules. But in fact, FIs need to do their own FATCA compliance procedures in addition to KYC.
Okay. One comment is that this is a matter that's going to be primarily dealt with by IT and tax. What are your thoughts on that, or is this truly interdisciplinary in its scope, involving compliance, operations, legal?
Yeah. This is definitely interdisciplinary. So all of those departments that you mentioned, in addition, your front office, so people dealing with customers on a day-to-day basis, need to have FATCA education to know, what additional requirements need to be requested during the onboarding process. So, the solution, IT was one of the first items you mentioned. The solution may be IT, it may be manual. It depends very much on how FATCA impacts your specific business lines in each of the individual countries in which you're operating. But definitely the solution will involve a number of different related parties. So operations in terms of processing compliance, on the onboarding, legal in terms of the contracts which you need to agree with other parties, front office dealing with clients, IT if you need to make changes to make additional fields to your systems. So there are a number of different areas.
Yeah, I totally agree. And this is very much a high-level compliance risk management exercise. And a key figure in this is the so-called responsible officer who will be making representations regarding the institution's compliance obligations. And if the shit hits the fan, it really hits right there. And so to me, it's overwhelmingly a compliance exercise, which involves all of those different areas that were discussed. Now, one other point that I'd like to emphasize is that when we talk about the knowledge of an institution, whether a customer is a U.S. person, that includes not only what's in the records, the computerized records, but it also includes whatever is within the knowledge of the relationship managers. So, having a nice computer review is good, but if in fact there are relationship managers who have actual knowledge of U.S. person status of customers, that's very problematic. So the exercise has to go well beyond the IT review.
Okay. Richard, was there any progress in the IGA discussion with Hong Kong about the mandatory provident fund and MPF and ORSO and voluntary contribution accounts? Can they be excluded? That's going to be a matter ultimately for negotiation between the Hong Kong government and the U.S. government, but those specific discussions have not yet commenced. It's clear that the Hong Kong government has done extensive analysis of the issues, but the specific negotiations, discussions on that have not yet commenced. Okay.
I think AJ, that's a very important point.
Yep. Go ahead.
Sorry, just to add very quickly. In each of the countries, Hong Kong being one of them, what we see is the industry actually pushing the governments to agree IGAs because one is potentially you simplify your reporting and withholding process, but also one of the key items is the products that can get scoped out within the IGA process, particularly pension products. So we see across the region in a number of different countries, industry bodies really lobbying their governments to actually go ahead and agree these IGAs.
And I would say that there has been very good communication in Hong Kong between the Hong Kong financial services industries and the government.
Okay, that's reassuring to hear. I'd like to thank all of our panelists today for their time. We're just about out of time, but thank you all for participating as well.
Okay, thank you.
Thank you. Thank you very much.
Thank you.